Welcome back to the Deep Dive. Our mission here is to synthesize the most important intelligence from major earnings calls so you can walk away well-informed and fast.
And today we are tearing into the fiscal Q2 2026 earnings call from Darden Restaurants. That's ticker DRI.
And this one, well, it really needs a deep dive because Darden served up a truly conflicting picture this quarter.
It really did. On one hand, you have this just exceptional operational excellence. The demand was strong, a powerful value proposition. But on the other hand,
they paid for it.
They paid for it with margin compression. The call happened pre-market, and you saw the stock spike on that great top-line number, but then it spent the rest of the day sort of wrestling with that margin reality.
So our goal here is to figure out if that high cost of winning market share is a temporary investment, which is what they want you to believe, or if it's, a permanent condition.
Exactly.
Okay, let's unpack that central conflict. The quick snapshot really shows why the market had whiplash. The revenue side was, well, undeniably strong.
It was. Darden posted $3.1 billion in revenue. That handily beat the consensus, which was sitting around, $3.07 billion?
Right.
And that translated into a really robust year-over-year growth of 7.3%. Their same restaurant sales, the comps, were also very healthy. Company-wide, they hit a positive 4.3%.
And those are the headline numbers that got the bulls excited right out of the gate.
For sure. But then, of course, the bottom line tells the cautionary tale.
Precisely.
Adjusted earnings per share, or EPS, came in at $2.08. Now, that was a slight miss. The street was looking for about $2.10.
And 2 cents might sound small, but in this context, it was a huge signal.
It was. It immediately signaled that management's strategic choice to really lean into value, combined with just a relentless cost environment, squeezed that bottom line harder than most people were expecting.
It was confirmation. They were spending money to gain market share, plain and simple.
Yep.
So let's pivot to that market share story, because that's the metric management really wants us to focus on long term. Darden didn't just have positive comps, they widened the gap significantly.
They did. Management was really explicit about this. They said their same restaurant sales and guest counts beat the industry benchmark by a full 300 basis points.
300! That's not just holding serve, that is actively stealing share from competitors.
It is, and the fascinating part is how disciplined their brand strategies are. Each one is really tailored to achieve that separation.
Okay, let's start with the big one, Olive Garden. They delivered a strong 4.7% in comps. How much of that is just them sticking to that core value message?
A huge amount. I mean, the cornerstone is their operational focus. It led to all-time high guest satisfaction scores, which is incredible.
And of course, the never-ending pasta bowl.
That's the physical manifestation of their value strategy, isn't it? They've held that starting price point at $13.99 for the 4th year in a row now.
Which is just wild in this inflationary environment. Holding that price sends such a powerful signal. But, what are the logistics of that? Management mentioned record refill rates. I mean, is there a point where that much abundance starts to just kill your margins?
That's the tightrope, right? They are betting that the extreme perception of value drives traffic and frequency, and that more than makes up for the high food cost on that one specific item.
It's a loss leader.
A very effective loss leader that gets people in the door to buy the higher margin drinks and appetizers.
They're also making some interesting moves with the menu itself, like this lighter portions menu. It sounds like they're fighting inflation by offering deflation. Smaller plates, lower price.
It's a genius maneuver in this environment. It's 7 existing dishes, just scaled down and priced lower. It was in about 40% of their restaurants in Q2.
And rolling out everywhere else soon.
By January, yeah. And the immediate results were strong. They saw a double-digit increase in affordability perceptions and more frequent visits from guests.
Okay, but what was the trade-off? Did it drag down the average check?
It did, a little. Management quantified it as the slight drag, about 20 to 30 basis points in the quarter. So yes, the average ticket was a little lower than it might have been.
But they see that as a long-term investment.
Exactly. If they can get a guest to visit one more time a month, that small dip in the average check is more than worth it because of the added volume. It signals flexibility to the consumer.
All right, switching gears completely. LongHorn Steakhouse. The absolute top performer this quarter, posting, 5.9% comps?
5.9%. Just a monster number.
So if Olive Garden is winning on value and abundance, LongHorn seems to be winning on just pure quality and simplicity.
That is the core difference. LongHorn is the quality story. They achieved an all-time high score for steaks cooked correctly. That's a massive metric in that business.
And they're winning the culture war, too.
They are. Record low team member turnover. That consistency in the kitchen and on the floor, it translates directly into better quality control and happier guests. It's a virtuous cycle.
Before we move on to costs, we should touch on digital. Olive Garden's delivery with Uber Direct is maturing. It's about 4% of total sales. Is that enough to really move the needle?
I think so, because management framed about half of those sales as incremental.
So new business, not just cannibalizing takeout.
Right. It's new demand. And critically, this delivery channel is attracting a younger, more affluent guest, people with higher average checks. It's an investment in their future customer.
Which is why Yard House is now rolling it out too.
Makes perfect sense.
So Darden has built this powerful operational moat. We get that. But moats are expensive, which leads us right back to the cost side of the ledger.
This is where the EPS miss came from. The core issue was elevated commodity costs. We're talking total commodities inflation of about 5.5% for the quarter.
Driven mainly by beef.
Primarily. Sustained near record beef prices that just lasted longer than anyone, including the company, anticipated.
And the explicit choice management made was key here. They actually said they're pricing below inflation as a long-term investment.
That's the whole story. Across the company, they ran 130 basis points below inflation in Q2. That gap is the secret to their success, but it's also the source of all the margin pain.
And nowhere was that more clear than at LongHorn.
Right. LongHorn, despite those stellar sales, priced an astounding 320 basis points below inflation.
320 basis points. That just highlights the immense power of their portfolio.
Yeah.
They can subsidize LongHorn's value perception with the scale of the other brands.
They can. For context, labor inflation was 3.3%, and they were able to offset that with productivity gains. But the commodity inflation was just relentless.
Where did you see the most acute financial pain from that pressure? Was it in the casual brands or the high end?
Oh, fine dining, without a doubt. The segment profit margin there dropped 280 basis points compared to last year.
Wow.
The high beef costs hit them disproportionately. Higher grades of beef, and you have much less flexibility on pricing before you start to undermine that premium perception.
So even the high-end consumer is seeing value promotions.
Yes, even in fine dining, they're being aggressive with value to drive traffic. Think Ruth's Chris with a $55 three-course menu, or Capital Drill's Wagyu and wine event for $35.
And these bring in new guests, but also it gives people price certainty, right? In an environment where the dinner check can feel like a total unknown.
That's a huge part of it. Price certainty is its own form of value.
Okay, let's look forward. Management is projecting a margin recovery. What gives them the confidence they can start taking price and close that inflation gap without, destroying the value perception they just spent a fortune building?
They give a timeline. They expect that pricing gap to total inflation, which they see at 3.5%, for the full year to cut in half in Q3.
And then catch up completely by Q4.
Exactly. And it hinges on two things. First, some modest price increases. Second, and this is the crucial part, anticipated relief in beef costs.
What's the evidence for that beef cost relief? Because if that doesn't happen, the whole Q4 forecast is in trouble?
Well, they pointed to macro trends. They've started seeing retail demand destruction accelerate. Demand volume for steaks was down 14% in November. But more importantly, from their perspective, they've already secured about 45% coverage for the back half of the year.
At prices that work for their guidance.
At prices that align with their guidance. So that contract coverage gives them a lot of confidence in that Q4 recovery story.
So what does this all mean for the full year guidance? Did the strong top line lead to an upgrade across the board?
They did raise the outlook on the top line. Total sales growth is now guided to plus 8.5 to 9.3%. Same restaurant sales also ticked up to a range of 3.5 to 4.3%, all very strong.
The bottom line, the EPS, stayed the same.
Correct. The adjusted EPS was maintained at that prior 10.50 to 10.70 range. It holds steady, which just reinforces that caution. That's the cost of maintaining value.
But they do expect it to get better sequentially.
They do. They're forecasting improvement, with Q3 earnings growth in the mid-single digits, and then Q4 showing the biggest leverage as that pricing gap finally closes.
And management also showed confidence by, putting their money where their mouth is, raising investment.
That's right. They raised the new restaurant opening guidance to 65 to 70 units and bumped up their CapEx spend to $750 to $775 million. That's a clear signal of conviction.
Plus the shareholder returns.
Yep, nearly $400 million returned this quarter through buybacks and dividends.
Okay, if we zoom out, the call gave some great color on the consumer. We know they're resilient. but Darden was pretty specific about who's driving their growth.
They broke it down by income. Their casual brands saw an increase in visits from middle to higher income groups. So households earning over $50,000 a year.
So Darden is pulling those people away from competitors, or maybe even from cooking expensive meals at home.
That's the theory. They did see a slight pullback in visits from lower income households, so under 50K.
But that weakness wasn't everywhere.
No, and this is a key detail, that weakness was less pronounced at LongHorn, which actually saw growth in that demographic. It suggests that for a value-conscious consumer, a controlled check at LongHorn might actually feel competitive with the crazy price of a good steak at the grocery store.
That's fascinating. The call really reinforced the story then. Operational excellence, discipline, value investment, the catalysts for the next couple of quarters seem really clear.
They are. First, the rollout of Olive Garden's lighter portions menu in January. Does the traffic stick? Second, the trajectory of beef costs. That's the big one. If that Q4 relief doesn't come through, that EPS guidance is in serious trouble. And third, just watching them execute on the new unit growth.
So the core debate is still there. Is this margin compression a smart temporary investment that will pay off, or is it the new normal just to compete? And now we reach our This Is Not Financial Advice segment, where we pitch an outrageous but plausible trade idea based on everything we just deep dived into.
Okay, so we've established the core conflict. Darden's traffic is strong, but their margins, especially in fine dining, are just getting crushed by beef costs. Segment profit margins dropped 280 basis points.
So you have a segment that's already driving traffic with value promotions, but its margins are the most sensitive to the one cost that's expected to finally come down in Q4.
Wow. That is the setup. So the outrageous but plausible trade is a beef headwind inverse pair trade targeting that Q3 and Q4 timeline.
Okay, explain.
The thesis is simple. Fine dining margins offer the highest potential leverage back to the mean if and when beef costs moderate like they expect. Their value promos are already working. They're getting people in the door. The only missing ingredient for an earnings explosion in that segment is cost relief.
So how do you structure the trade to capture that upside while, managing the risk?
You go long DRI stock, betting on the overall execution and that eventual margin recovery. But simultaneously, you hedge by taking a short position on a basket of pure play, high-end steakhouse competitors.
The smaller guys.
Exactly. The smaller peers who lack Darden's scale, they can't afford to price 320 basis points below inflation. They'll be forced to raise prices, which might kill traffic or suffer even worse margin compression.
So this play isolates Darden's operational wins while making a specific bet on the recovery of their most depressed segment. It's a double win if that beef cost forecast is right.
You got it.
A fascinating play. Okay, to recap the Q2 takeaway. Darden is successfully widening the gap against the industry by using calculated margin pressure to secure traffic and protect its value perception.
And we'll leave you with this provocative thought for the listener. Management noted that Olive Garden's delivery channel attracts a younger, more affluent, higher frequency guest. It's serving a fundamentally different demographic than the traditional dining customer.
So the question is, does the success of this digital channel fundamentally change the growth ceiling for traditional casual dining?
Right. If delivery transforms a brand like Olive Garden into a true omni-channel play, does that warrant a higher valuation multiple long-term? One that goes way beyond just counting new store openings. It could change the whole narrative of what a casual dining company could be.
Something substantial to mull over. Thank you for joining us for this deep dive into Darden Restaurants.
Until next time.